Good afternoon. Good afternoon, everyone. I'm Bagadon at StockMarketCaddy.com, and today is Friday, November 26th, at a little bit past noon. This time last week, right around here, around the 17th and 18th, we placed some option trades for our members to review. The first trade is this one, the NASDAQ 100. We placed a put option out to January 7th, a strike price of $16,600. We paid $45,000. Yes, that would be a lot of money in anybody's book. However, let's think about what a put option actually does. When you buy a put option on anything, a market, a stock, and the price goes down, within the allotted time that you have, you stand to make money. We'll put it that way. So, if the stock market had continued to run and run and run and run through January, this contract would go down in value to the point where if the market never corrected, one could stand to lose approximately $45,000. Pretty scary, right? Well, yes and no. You're not locked in cement. If you buy the put contract, you can always sell the contract. You can sell it. You could have sold it if it fell in price and get down to $25,000. You could sell it for $25,000 and realize the loss. You could certainly do that. But notice the market did go down and is going down again hard today. It has gone down since last week. This contract is actually up nearly $30,000. That is, if I went into the market and went to sell this contract, I bought the contract for $45,000 and I went to sell the contract, there are banks, hedge funds, rich individuals that will say, you know, that was a pretty good idea to buy that contract last week, and I'm scared that the market's going to go down further. So you know what? I didn't buy it last week, but I'll buy it this week from you, and I'm going to pay you an extra $30,000 for that contract, and I could put that money in my pocket. Now, that is a speculator, and you might be thinking, well, I'm not a speculator. And that's fine. Maybe you are an investor. Maybe you have $1.6 million worth of NASDAQ stocks. If the NASDAQ, and it's a big if, nobody knows the future, not us, but if the NASDAQ should decline 10% by January, a person who is holding, and this is all scalable, right? You may have more stock, you may have less stock. But if the market goes down 10% and a person is holding $1.6 million worth of long-only NASDAQ stock, they will be down, their account will be down approximately $160,000 if they do nothing. For the person who has long-only stock, and for the person that says, you know, I have $1.6 million worth of stock, and I think the markets are primed for a fall, if that person bought a put option, then this put option would be worth at least $160,000. So it acts as a hedge, as a protectorate, as an insurance policy. Folks who want to do that need speculators so that they can buy and sell these products whenever they might want to do that. If you don't have speculators, you don't have people buying and selling them, then when you want to get a hedge on, you don't have anybody to buy or sell to. We'll come back to this in example, and I know what you're asking yourself, well, how would I know? How do I know when to do this? I'm going to show you in a moment. This is the S&P 500 as an example. In this example, we did what is called a vertical put spread here. We actually bought a put and then turned around and sold a put. We'll just leave it at that for right now. That cost us a lot less, just $5,180. So we don't have as much, the bet isn't as big. It isn't as big. Up here, the notional value of this contract was 1.6 million. The notional value on this was about $470,000, about 1/3 the size, a lot smaller. If we were to close this contract today, close it by selling it, we bought it. If we sold it into the marketplace, said, here, you take it, I'm done, we would realize $3,000 and we would have cash. This was also a put spread on NetEase, and this contract cost us $2,275, and it isn't working out so well. It's down $1,400, or nearly half the value. So come Monday or Tuesday, because we have lost about half the value, that is one of our rules of thumb, we will close that contract. But you can see down here, since last week, these three positions cost $52,505. Quite a bit of money. So we had to be accurate with our placement and our timing. Our profit, if we were to close all three of these, which I'm not going to do now, but if we were to close them all right now, our profit would be $31,500. And I know what you're asking. How the devil did you know, Bag of Dawn, that this was going to happen in the next 10 days? Let me show you. This is our tool. By the way, the positions that I just showed you are reflected up here. They have been up even much higher. This tool is called SMC for Stock Market Caddy Driving Range Radar for active traders. Timeliness. What in the world is this doing? And how did this help us? This is what we used to put those trades on. And let me show you how this works. First, these are the markets over here. And you could put in stocks, you could put in anything. This is the S&P futures contract. This is the NASDAQ futures contract. The interval is a daily. We'll come back to that in a moment. Very, very important here. This is going to help you get a perspective. We don't really need to be listening to CNBC or the IBD or really anybody here, because this tells the story. This is the last price. This is the net change. Now we come all the way over to here. Do you see this? This is the mean price. The mean price. The mean price on a daily interval is $45.99. Well, what a coinky-dink. Look where it's trading at. $45.99. It's right here. It's trading at its mean. The NQ, the mean, is 16,080. Are you kidding me? We're at 16,080. The Russell, 2364, we're trading 2238, well below its mean, well below. The Dow, 35,811, and we're trading well below its mean. You see, a week ago, a little more than a week ago, the markets were over here. They were in what we call euphoria. They were trading more than 2 standard deviations away from their daily mean. When prices are way over here on whatever interval you're trading, we know that the statistical likelihood is that price will move back toward its mean, and if people panic on a daily level, it will even overcorrect. So when prices are over here, that is a really good time to get insurance on one's portfolio. When prices get over here, it can be a really good time to close out those insurance contracts, or maybe even begin to buy the market. Maybe. Because I want to show you something a little bit further. So the likelihood is that come Monday, the markets will be panicking, and the insurance contracts that we bought a week ago when the markets were over here, people are going to want to be buying them from us when the markets are here, and we're going to sell them those contracts and realize a profit. Warren Buffett has a saying that he likes to be buying when they're crying, when prices are over here. When they're crying, he wants to be buying. And when they're yelling, he wants to be selling. Now, I know what many of you might be thinking. Good grief. I can't be bothered with this stuff. I don't want to be a speculator. That's fine. You don't have to be. But maybe you're an investor. So let's change the time frame to a monthly view. Are you kidding me, bagger? Let me show you this as an example. So when your broker or your booker or whoever it is says, oh, don't worry about it, the markets are only go up. Okay. This is now on a monthly interval. The exact same markets. This is the S&P. The S&P is trading at 4,600. It was higher, right? We were up in here just last week on a monthly basis, We know when prices are up here, the statistical likelihood that over the next 20 months, which is nearly 2 years, you think, oh, that's a long time. Well, that price will move back at some point to its mean, which is 28.45. In percentage terms, that'd be nearly a 50% haircut. The NASDAQ is currently trading at 16,000. The mean is 7,000. The Russell, 1,500. And the Dow, 25,000. That would only be about a 30%, 40% haircut. It's not a guarantee. It's a 95% likelihood. There's a 5% likelihood that it doesn't correct and it extends and extends. But 95% likelihood that we do come back to the mean. But just as we're doing on a daily basis, it's entirely possible that when we get here, people panic. And the markets do what? They overcorrect and they come way down here. And the prices could be underneath their mean for an extended period of time. I hope to have plenty of cash because why? When they're down here and everyone is crying, I want to be doing what? I want to be buying. And you want to have the cash to be able to do the buying. I'm Bagger Don at StockMarketCaddy.com. In 13 minutes, we have shown you how you can look over the shoulder of your booker or your broker, over the shoulder of CNBC, the Wall Street Journal, and the Investors Business Daily, or anyone else filling one's head with all the narratives of the markets. Markets do not move on narratives. Markets, 90% of all the market activity that you're seeing today, that you're seeing last week, that you've seen over the last 10 years or 20 years, is being moved by computers, computerized algorithms that are trading the money flow. And much of that money flow is based around standard deviations. Reversion to the means. It's just a question of your time horizon. As I said, when we're at a monthly basis, it could take 20 months for it to get to 28.45, not 10 days. As speculators, we trade very, very small, intraday, daily, quick. We'll get multiple opportunities. We'll get multiple bites at the apple. But this is where you are on the S&P, NASDAQ, Russell, and the Dow. We're out here. Could the markets gobble up the latest little correction and continue to hang out here? Yes, they could. They could, and they could go a little bit higher. But what we do know is over the next 20 months, a very strong likelihood that we're coming back into that mean. Good luck, everybody. If you like this approach to the markets and you want to have these tools on your desktop and you want to know how to use them, feel free to give me a call. 813-758-8263. I'm Bag It On. We have over 70 proprietary indicators and strategies to work with so that whether you're a speculator, an investor, or someone who just wants to look over the shoulder of their broker, these tools could be sitting on your desktop. In addition, you have the opportunity, before you do this, to spend more than 3 weeks, nearly a month with me, day in and day out, so that we can show you how to work with these tools. Like everything, it is an acquired skill, just like golf. Good luck.